No changes to the recommended portfolio today. We're pretty stable. You know, we bought Activision Blizzard because it's being taken over by Microsoft and is trading at about a 25% discount to the takeover price. So it should be executed within 18 months, but probably within 12, probably 12. And we see no risk that this is not going to go ahead, but the market does see a risk there. But because that is just stable, so when the market's going up and down, just expect that to be stable and eventually start to increase some. Overall, we had some good performers this month. Today, what we're talking about is the polarized bears, because, you know, we do the bulls versus the bears, but what we're noticing now in the market is that some of the bears have become very polarized in their view. And so we want to talk about how Goldman Sachs is really more agile and shifted to the bear camp. But as you'd expect, who's the biggest bear and most consistent bear? Morgan Stanley and Mike Wilson. The guy is just, you know, I don't know how he has any money left over to maintain his bearish positions, but, you know, I think he would have been shorted out of everything. But he's still around somehow. I don't know how he survives. But we also want to talk about the irony trade, because, and Steve is good at this, but there's policy coming from the Democrats, which is green, and it's anti-big oil, and it's pro-clean energy, and it's tax the rich and redistribute to the poor. And, you know, there are also other main planks to their political platforms is, you know, get rid of guns, which I agree with, right? But, you know, Republicans like guns. And then the other one is they're Christian. You know, the Republicans are Christian and the Democrats are not. But the irony trade is that if you tax the rich and redistribute to the masses, you shouldn't be feeding money directly into the profitability of oil stocks, but that's what you're getting. So the irony of the policy coming out from the Democrats is that it is just feeding a lot of cash into the profitability of oil companies. So we've seen the surge in the oil companies and this period. This month, now last month the market was down about 10%. This month it fell 5 and recovered 5. It ended the month down about 0.6%. The earnings estimates were cut by 0.3, but the earnings estimates are down for some FANGs and some of those high growth stocks where some reality is coming back after years of really aggressive run-ups for those high growth sectors, companies that really benefited from the pandemic, like Zoom and well, we've covered this Teledocs and lots of others. But we do see the S&P 500 now at only 16.7 times earnings. So when you look at 16.7 times earnings, you think that's pretty cheap. But why is it cheap is because maybe those earnings are not sustainable. I think they are. Maybe they're not. Why wouldn't they be? And what are the risks that are going to affect those earnings? And why is there a wide range in expectations, a high standard deviation in expectations driving down that price earnings ratio? Why are we getting multiple compression? And so we want to think about what the risks are that are driving that and what risks are going to be mitigated or are just maybe momentum selling to the downside. Treasury yields up to 2.74, and that is still relatively low compared to what we would call the envelope of sensitivity. So remember back in, I remember Carter having hyperinflation because they tried to control oil prices. Nixon tried to lock in prices, control prices, and then everything got away from him and you had the surge in inflation back in the 70s. And so you had 10-year treasuries at 10%, you had price earnings ratios down to 10 times forecasted earnings. So you got, 10% yield on treasuries, 10 times earnings. Then during Greenspan, the inverse happened. So treasuries went down from 10% to 5%, Ps went up to 20. And then you had the dot-com bubble in 2000. That's 20 years ago now, 22 years ago now. But the 10-year came down to 5 and the Ps went up to 20. Now, once you get, treasuries going below 5, you're not going to get Ps going up to 30. It's not going to reflect the same year duration payout as you would get in a bond. So, so what we're looking at now is that we're outside the envelope of sensitivity on multiple compression, but we are seeing this increase in interest rates affecting the discounted cash flow model and the cost of money put into the discounted cash flow models for companies with high growth, and we want to talk about that. So, and it will also affect mortgages, but most importantly, it's going to affect the cost of money to the U.S. government. So the borrowings are fairly light with the consumer. They've got some mortgages. Corporations are highly cashed up, so they're not really largely affected by a rise in the cost of money. But the real people who are going to suffer is the U.S. government, and they're going to have a much higher increased cost of servicing debt. And there seems to be this never-ending view that they'll just borrow money or deflate out of it or inflate out of it or something, and I just don't buy it. So to see Biden add to, yes, Chairman.
So the tax receipts, what does the interest rate need to be before the government can't settle up the debt with tax receipts?
Well, they can't settle now, right? So they have, God, you know, they did all these numbers. I'm gonna have to pause and think about it a little bit. They spend money on Medicare and Medicaid, and they spend money on Social Security, and then they spend money on what's that? Military, and then 30% of the budget, and then they spend money on interest. And interest is going to be what percentage of it?
It's about 10%.
About 10% of the budget.
Between 7 and 10%. It spiked during COVID, of course, because they ran a $3.5 trillion deficit.
So Trump stimulated the economy, and then Biden came along with too much, too late.
Yeah.
And then added another 1.9 trillion, increasing the total deficit of the U.S. from about 24 to about 26 trillion.
That's about right. Yeah,
it's about that. And so how much of that 26 trillion is part of their budget? And I'm going to say that their budget is a total of 6. U.S. government?
No, it's close to 4.5.
So it's not 30% of
it was 6 during COVID.
It was 6. It was okay. It was 6 during COVID, but so if you think of the U.S. GDP as 20, and then the U.S. government being a quarter of that, then their spend would be 5, right? So if their spend is 5, their interest component is 1.5 or 2.
That's about right.
1.5 or 2, and then so if you increase interest rates by 10%, it goes from 2 to 2.2. Or 2 to 2.4. So, but it becomes significant because, you know, they got to borrow to pay that. And it just seems to be going up and up and up. And we haven't had any real containment on government spending since the Tea Party. And the Tea Party, it's time for another Tea Party, if you ask me, right? We really need to get control over this spending. I think it's gotten way out of hand. So I don't know if that answers the question. It's sort of getting me to think through.
It's not as high a percentage of the budget.
It's what?
It's not as high a percentage of the total budget as I thought.
Yeah, well, that's because interest rates are so low, and if interest rates go up, so let's say interest rates go from 1.75 to 2.75. Let's say they go to 3.75 or 4.75. Let's say they go to 5. Now it's not serviceable.
Right.
You just can't afford it anymore.
Yeah, so double.
So you need to inflate out of it, right? So so I think it's getting tighter and tighter and tighter. And I'm not happy about it. The VIX rose from 20 to 35. Sorry, Jeremy, am I covering enough of that?
Yeah.
Yeah.
You know, I might just point out that the Biden administration came out with their 3.4 fighting inflation, and the third plank is deficit reduction, which is great. However, their plan for reducing the deficit is not to cut spending; it is to raise more taxes, which isn't going to help inflation because the spending levels, the fiscal stimulus has been
Well, it was record tax
major problems
receipts.
in the inflation number now.
Yeah,
We're talking about these record deficits, but when was the last time it ran out of surplus?
when did it run? Well, I remember Greenspan saying, "Careful to Bill Clinton. You know, careful. You're getting. You should be borrowing more." And so, running at a surplus. I don't know. I don't see why I shouldn't run at a surplus. You know, why can't we run even? Why do we got to borrow money?
Basically, it was built.
So
That it
never happened.
in the second term.
I don't.
So call it 1997.
So I'm fairly unique. So I bought a house when I was 40. I saved to buy a house. I bought it with cash. I've never borrowed money. I've just always been a saver, and I've always been like, you know, ever since I was in college, like my professor of investment said, you know, it compounds. You save, you save, you save, you save. So that's always been. I've never been a borrower. I've never been one to borrow to buy a car, to buy a house, or buy anything. I have to borrow to pay my divorce lawyer, you know, choice. But they're good, right? They're good. Okay, and
So you
extract.
might believe in the end.
What's that? Does anyone know a good divorce lawyer? I didn't think so. So that's my joke about divorce lawyers, right? Okay, the VIX. The VIX is going up from 20 to 35 and back down to 26. Okay, now Cantor Fitzgerald would say when the VIX goes up, you buy the market when the VIX gets up to 35. But this month, the market went down 5%, recovered 5%. So they would have been right to say buy at 35. But remember, during the global financial crisis, it went to 80 and then 60 and then 40 and then 40. So it can go higher, especially when you have so much debt around. The irony trade, of course, is the 1.9 trillion in rescue money went straight to the bottom line of oil companies, contrary to the green energy policy, leaving you with some long-term debt.
Do you think they'll do a windfall tax on the oil company?
Geez, that's a good idea. I like that idea. I like that idea. Yeah, then we would really.
That's
be
what Boris is
screwed.
doing. But they're not calling it that, but that's what.
But that's.
We need more.
The
we
tax
need
system,
more-
the government doesn't collect it, it's spent on development.
Yeah, I'm not sure what the spending
Tax,
plan is.
or
But who commented about opening Keystone? What that opening back
That's
up? I hadn't read
subsidized.
that. What? Is that gonna happen?
I don't know, the
I'm
UK,
sure- I'm sure I saw something the other day, that they went over the case.
The Republicans in the House and Senate are trying to push for
Well,
legislation.
Well, I'll make a prediction right now that Republicans are gonna get control of one of the houses, you know, and so they might not have control of the executive office, but they're gonna have a lot more power in October, November. Alba Marble is a very, you know, I got, you know, it's horseshoes and hand grenades, right? I got close to recommending that recently. It surged this month. You know, does anyone know what Alba Marble does? They do the raw materials for the batteries for electronic vehicles. And they got like the cobalt coming out of Africa and the Congo, and there's all concerns about where it's coming from. They're a chemical company, but they mine for raw materials for the EVs. So a very important company, and it could do very well. But coming down the list here, we got Devon, Occidental, Marathon, Schlumberger, Conoco, Baker Hughes, and further down, well, some other stocks. We don't know those ones at the bottom, but there's a lot of oil in there. A lot of oil, really surging on the oil. The other ones that went up here, Viatris, Electronic Arts, Western Digital, and Paramount. You know, Electronic Arts, we sold our shares in there, and it's up 17% this month, but that is up on a potential takeover rumor. And we had written about 3 years ago when we were invested in Electronic Arts about the low barriers to entry and the number of mergers and acquisitions that are going on in this industry. So to see Electronic Arts as now a potential takeover target gives us a lot more confidence that there should be no problem with Microsoft buying Activision Blizzard for $60 billion, right? And then the next big acquisition out there, another $40 billion acquisition, is VMware got a takeover offer. So some Broadcom, and so Broadcom's no longer what's his name? Choktan? Hawk-Tan. So he went to Harvard, but he's based in Singapore. He couldn't buy Qualcomm because Trump said you're an Asian. And so he moved the company back to the US. Now they're buying VMware, and they compete with Citrix. And so to see Citrix and VMware, and wasn't VM owned by Michael? Yeah. So we're seeing a couple of takeovers going on in here, VM and Electronic Arts, but nice to see some of the stocks that we own here up for the month, Paramount and Western Digital Electronic. On the downside, Target and Walmart, they had bought, just in case, a lot of inventory in anticipation of people spending on this 1.9 trillion. And then they got supply chain problems. They had excess stuff and had to write it down. So it had very bad results from the retail companies in general, particularly Amazon, Walmart, and Target. And it's about timing issues and having to write down cheap inventory, not expensive inventory. So any stuff that's the cheap tracky back stuff, that has to be written down. But if you want to buy a Brooks Brothers suit, that's not getting written down. So also to the downside here, you see Walmart, and then Royal Caribbean and Carnival also went to the downside. There's a couple of reasons for them sinking. In my, our group of people here are a demographic that are more likely to go on these trips, on these cruises. And I'll tell you, our demographic doesn't like to come into the office here because they're afraid of getting COVID and they're online. So, this demographic is less likely to get on a boat with, 2,000 other people that are our ages and risk getting sick. So so they built up all this debt, they have all these fixed costs, and now they have these surges in wages for people. I just don't see these companies really surviving. I don't see people just going back to cruises in another 3 or 4 years, even after COVID's done. I think that I went on a cruise and it was wonderful, but would I do it again? I did go on a very nice cruise through the Caribbean and I went to Rhodes. It was very nice. Anyone been to Rhodes? In the Mediterranean or Knossos? Have you ever been to Knossos? I saw some wonderful places, Rhodes and Knossos and Athens, and I went to Ephesus. What did I say? Ephesus, that Greeks, that city in Turkey that's just like Athens, but abandoned 2,000 years ago. Anyway, so the cruises have a lot of good stuff about them. Oh, and I love telling the story about how I was sexually harassed at the Vatican. So I'm going to take a short. It's a true story. I was sexually harassed at the Vatican. Okay. So
Was it
this
a
is
priest?
what?
Was it a priest?
It was not a priest. No, it was not a priest. But on these cruises, they have a lot of they call them mobily impaired people. I call them obese, but they have a lot of mobily impaired people. And I wanted to see the Sistine Chapel, so I went on one of their guided tours. And there was this woman walking behind me, and she was a 300-pounder, and she had very large breasts. Anyway, she's walking behind me, and she keeps bumping up me from behind. And I'm like, well, stop bumping your breasts against me, And so it's true. I was sexually harassed in the Vatican by an American tourist. So the solution to that, by the way, is if somebody's bumping you from behind, all you have to do is turn and walk backwards, because when you walk backwards, they suddenly give you space, right? So if you're ever being sexually harassed in the Vatican, just turn around. There. I hope some people online are laughing too, because I'm getting some here. What moves the market? Interest rates, earnings, and liquidity. I think earnings are pretty solid. What we've got a risk of here is number one, oil has gone up. Okay. So the biggest risk might be taxes, but I don't think so. Let's talk about liquidity first. We have a question here. Somebody wants to know about me being. So did you enjoy the Vatican? Yeah, it was great. The Sistine Chapel is pretty special and wonderful place, and I really did enjoy it. Thank you. Yeah, but imagine if I was walking up, bumping behind that woman, she would have been onto the police, and I would have been locked up. But sorry, am I doing the woke thing? Liquidity normally refers to you would pay a lot more for Microsoft than you would pay for Viatris, because Microsoft is easy to get in and out of. But now it means a different thing. Steve, would you like to talk about the liquidity that quantitative easing is generating? And
Right. Well, presently, up until about 6 months ago, the Fed was buying back up to $100 billion per year in various fixed income instruments, including mortgage-backed securities and treasuries. So that increased the balance sheet on that from about $4.5 trillion to about $8.5 trillion in 2 years. Now they're easing off of that, and this is one of the reasons interest rates are going up, because a large buyer is no longer buying at the pace they had been. Ultimately, they want to end the quantitative easing program by November of this year. That's the schedule that they've guided for, but it has already commenced. So that's pulled a lot of liquidity out of the market, and therefore rates are going up, interest rates are rising.
the liquidity is creating inflation, right? And creating risks.
Higher rates, yes.
Earnings are solid. We've got this pig in the python. So I refer to this 1.9 trillion that Biden gave as a rescue plan as a pig in a python. In other words, it's something that the economy is digesting, and it's a big bulk of stuff that it's digesting. It's causing wage pressure, which is causing inflationary pressure because the wages are creating demand for food and demand for petrol and demand for other things. So as these wage pressures and these spending checks get spent, then there'll be less demand for these things and it'll fall off and the inflation will fall back off. So there's a lot of argument. Is it a peak? Is it a peak and a plateau? Or is it just going to come back off? And I say it's going to come back off and some of this will retrace. So oil is doing well. Wages are not sticking. So there's a big argument that once you raise some of these wages, you got to keep them high. Well, I think that maybe in Australia, there's more of a requirement to keep employees than there is in the US. And so we might be lulled into this idea, being Australians, that you can't get rid of people, but in the US, there is more flexibility to turn over those staff and hire people at a cheaper rate. So there's more flexibility in turning over staff in the US. COVID in China caused a jolt in supply chains. The biggest risk there is Apple. So, we've seen Netflix crash. We've seen Amazon crash. We've seen a lot of companies, take big, steep falls. A lot of them and even Tesla's taken a big fall. Will Apple be the next one? Okay, and they've opened up in China now, and Foxconn supplies Apple, and Apple's talking about readjusting their supply chains, but they seem to have really managed all this product that comes out of China into those phones really well. But could there be a shock there? And I think there's a risk that we should all be aware.
Do they own the tier one suppliers, Apple, or are they independent?
No, there's a lot of local Chinese production companies making stuff, and there's so many different things that go into it. And it's not just a Chinese assembler. It might be a US chip maker that's making, the memory or the Qualcomm, the communications chip. And so there's all these other technologies that are being assembled in China. And so is a very, very complex supply chain. And we've heard nothing from Apple about supply chain problems.
That's plain and simple.
So, which means that, are we all lulled into this confidence there? And is there a potential risk? So I'd be very careful of Apple right now.
But they're paying huge bounties. So Apple are paying a huge amount of money to their suppliers to secure supply and locking other people out of the market.
Premium.
So does that mean that they're going to have lower profit margins because they're paying the bounty? I mean, they're going to sell product at a higher.
They've got a lot of money in the bank. But,
Yeah.
but the thing is, Apple have, last I heard, Apple have spent well over $1 billion in securing their supply chain with bounty payments. So it's not advance payment for product, it's a cash payment to say, you will supply me or you supply anybody else.
Loyalty payment.
And other big companies are offering to do the same thing. The thing is, Apple got in at the very beginning. They're at the front of the line. Intel is doing something similar, but not quite as exposed. But a lot of the other product companies, big companies, telecommunications companies, can't get chips that big because even if they pay 10, 20, $50 million as a bounty just to get the product supplied, they have to pay for anybody. It's not available because Apple and a couple of other people have to supply.
That reminds me of Jack Welch. Jack Welch could see things going in the
So
economy
you couldn't do that in America.
before the problem happened.
Sure.
He could see what was going to happen. And I think if that's the case at Apple, they're seeing things. They've got a CEO and a group of people that are smart and seeing things before they happen, and they're managing the company really well. So that's a good sign, but also a little bit frightening. Maybe there could be a problem, but maybe they're handling it really well. I'd like to read more about that. I'd like to know more about that because I think that if everyone else got a supply chain problem, why don't they? And if it's bounties, is it going to affect the margins? And maybe they're just that smart.
Probably won't affect the margins, Joe. They'll check the price. Because there won't be the competition out there.
Samsung's got a problem now, right? Yeah.
So, if Apple's the only phone on the market, you can't get your Android phones or whatever. They seem to have a lot of flexibility in their pricing structure.
We're going to call Andrew Cortman and ask him.
They do that.
Don't know about it. Okay, let's move on. Interest rates were outside the envelope of sensitivity. The 10-year stalled, so it went up to 2.75 or 2.9. It stayed there. And so the discounted cash flow analysis, if you're waiting, and the discounted cash flow, what you're saying is how much money you're gonna make, one to the next 3 years, and then to the next 5, the next 10 years, and what is your cost of capital for that? And if you increase the cost of capital by 200 basis points, then your discounted cash flow spits out a much lower net present value. And so if you increase the cost of capital by 3%, but your growth rate is 25, then, how sensitive is it really? So, but if your growth rate is 20 or 15, then increased weighted cost of capital is greater. But what's going on in the market now is any of the super ultra high growth companies, which don't have that weighted average cost of capital, they don't have it, but their investors do. But if you look at some of the, what's the one that Oppenheimer recommended last quarter that went down 40%? The Texas app company. No, but anyway, we'll come to it later. But a lot of these high growth companies come down 40, 50, 60, 70%. The high growth companies with like 40 billion market cap, but down from 80 billion, but only 2 or 4 billion in sales, these types of companies. There's a lot of those out there that did very well during the pandemic, right? Foreign political risk. Okay, so talking about foreign political risk, I read a lot and I hear a lot about Putin's war, which in Davos is now Putin's war, not Russia's war, and I don't see it as a factor in the strategists' reports. The strategists are not saying sell or buy the market based on, well, they are, some of them are saying buy it if the war ends, but I don't see it affecting the estimates. So it is kind of irrelevant, surprisingly irrelevant for the amount of noise that it gets. Okay, so Davos is demonstrating that the political risk this period is unchanged. They get together in Switzerland and they
Sure, it's relevant from oil prices, wheat prices.
oil and wheat, food and energy, important things for Europeans, Indians, and Asians don't care. That's your war. That's your problem. Yeah. So it affects energy, and it affects energy more in the embargo on oil. But let's go back a step here. What does Iran? What does Iraq? Iran. What does Iran do about their oil embargo? Hey, you can't buy Iranian oil. Well, yeah, okay. Go ahead, build a nuclear bomb. Just let us have your oil, right? What's that?
Comply with the nuclear.
They sell it to somebody else. Okay, it gets into the system somehow, right? And it's a commodity and it finds its own level like water. So you can say we're not buying Russian oil, but it's going to go to India and get put on another boat and shipped back to Europe. It's going to find its way back, in my view, because that's what happens to Iranian oil, right? The West calls it Putin's war. Now, I'm going to, for people who weren't here for the discussion earlier, there were some people in the room here saying, "Is Putin alive?" Have you heard this?
No, I haven't.
Okay, so Mark, I'm going to put you on the spot. Jeremy, I'm going to put you on the spot. They said, some of these pigs, Putin hasn't been seen in public for a little while. Is he still alive?
Lot of big rumors
That he's
up north in the northern hemisphere.
in the northern hemisphere. Is
already
Putin
gone.
alive? The first I heard that, I'm going to go look that up. But that'll be a fun thing to look into, right?
Well, he was too worried about an assassination attempt shortly before.
Yeah.
Well, he'd be in hiding, wouldn't he? Yeah.
We did a public appearance at the.
Yeah, he's got a million dollars.
I was saying before though, there was some various photos taken of him recently at a factory, at a hospital, on picnicking on the beach. And they did analysis of all the faces, it was the same faces in all the videos. So,
Yeah, so he's
all these public appearances.
So he's like
Johnny
Johnny Depp.
Depp.
He's got his people who follow him around, right?
But he also does Botox, and so his face doesn't.
Oh, oh, does he?
So it could be the same face, just, at different
Well,
times.
apparently he doesn't attend the Kremlin or anything like that anymore. It's all done.
Oh, yeah.
All right. Okay. So we're gonna say that there's a rumor that Putin might not be around. Consensus is regime change is the only solution. It emboldened China on Taiwan, but then Biden stood up against that. So I think Taiwan is safer as a result of this, and I'm pleased to see that because the world doesn't want China owning Taiwan Semiconductor. They need Taiwan to be independent. Domestic political risk, we've got the rescue package, too much, too late. Ironically, the Democratic policies are putting money into the hands of oil, who are staunchly against climate change. So that's the irony trade. Biden's policy blunders are improving the prospects for the Republicans in the upcoming elections, and hopefully that will start to get some control over the budgets, which I think is desperately necessary because this higher interest rate is going to impact the cost of servicing debt. There are hopes for a strong defense and tighter budget controls. Healthcare policy is a hot potato. I mean, nobody wants to deal with healthcare. I mean, Obama did a lot to create these auction processes, and it's a hot potato right now. Nobody wants to deal with healthcare, and it's too confusing. Taxes and margins, Lena Khan. Janet Yellen went out as a Democratic leader for the Western world and said everybody around the world we should have minimum corporate tax rates, okay, so that Google or Apple can't go and make money in Ireland. And Ireland had to eventually capitulate and sign on to this, but now they'll provide incentives some other way, like Disneyland has got its own municipality in Florida, right? You'll create incentives some other way. The taxes should be localized. Taxes should be consumption tax, income tax, or asset wealth tax. You should tax the people in your jurisdiction, therefore not allowing companies to, corporate tax should be zero, is the bottom line, or close to zero. It doesn't make sense. So Janet Yellen's going around the world. We talked about that 2 years ago. Lower corporate taxes, higher local taxes make more sense. Trump tax cuts didn't go away. So when Trump cut the taxes, what happened is that the companies started having higher profit margins. And what did not happen is that smaller companies or international companies didn't come in to compete to reduce those margins back down. So we're seeing higher margins and sustainably higher margins. And that's a why sort of question. Why doesn't that come back down? Well, why are Australian banks, twice as profitable as any other banks in any other part of the world? Because it's the infrastructure that supports the dividends paid to you and charges people.
The holiday for returning offshore earnings is over, right?
Yeah, that was the Bush thing.
No,
Or was there more recent?
amnesty for the
Yeah, amnesty. That's finished, isn't it?
So Trump, I think it was.
Yeah, it's true.
Yeah, bringing that money back home. Why wouldn't you let them bring it home? I mean, so reduce corporate taxes.
Yeah,
I
the
don't
idea
know.
is
I'm watching that. Is that significant?
Well, I don't remember what the quantum was, but it was, and the idea was it would create more jobs, but there was no obligation to do so. So it flowed to special dividends and buybacks.
That's why Google has that cash and debt, right? So they might have 100 billion in cash and 20 billion in debt because 20 billion that's offshore and they borrow, hand to hand so that they effectively can bring that money back on shore, but it's technically offshore and it's tax structure.
Yeah.
Deglobalization is a trend going on. Antitrust, the US says we'll have 3 leaders in the auto industry, but we still got Toyota coming from overseas. We have 3 big leaders in food, but we got Nestle and Danone overseas. So we got Procter and Gamble and Clorox, et cetera, but we got Unilever. We got Pfizer, we got Glaxo. So the US policy has been 3 big companies. And then let the foreigners come in as we globalize, but as we deglobalize, we might have other competition coming in. The US punches above its weight in tech, there are the BAPs. So let me see. So one of the things coming from the strategists, and I'm kind of going to what I'm seeing as a summary of what's coming from the strategists here, but there's always been this argument that tech is cyclical, okay? And right now, what we're saying is that collective learning is causing a hockey stick shaped increase in knowledge and in technology, which is taking some of the cyclical out of it as we advance our knowledge through collective learning. So that reduces the cyclical nature of technology, but it doesn't reduce the velocity of creative destruction, actually increases the velocity of creative destruction. So you might have a Procter & Gamble at 23 times earnings with no growth. And then you might have a Google at 15 or 16 times earnings with good growth, because there's the risk that there's higher replacement or velocity of creative destruction, or someone else come along and replace Yahoo, right? So those are some of the issues that the strategists are grappling with, and why Thomas Lee from FundStrat is pointing out that companies with no growth are more expensive than companies with good growth. And that's because of the velocity of creative destruction, bearish entry, and things like that. Blockchain, genomics, electronic vehicles are coming fast. And ARC Innovation Fund, Kathy Wood's fund, is in the eye of the storm. I would say speculators ought to start looking at that. Now, they own some pretty high flying stuff like Teladocs and Zoom and Tesla, but it's time to start looking at that stuff again, because that's been just obliterated over the last several months. Now, what time is it? Just keeping up my own time. 1:38. I'm going to let you guys talk about stocks, but before I do, let me just say
Consumer
that
sorry, just one more question.
Yeah,
Consumer
yeah.
confidence is still falling,
it's
right?
no, it's pretty solid. It's been pretty solid. Consumer, both on Michigan and the Conference Board, has been okay. The one that's frightening to me is a trade deficit going from, typically 40 to 120 or 110, because when you import goods and export US dollars, then China or Saudi Arabia have those US dollars and they have to spend them. And the best thing to spend them on is US treasuries or exchange traded funds. So, because there's only so many Waldorf Astorias they can buy before, they're told you can't buy another Waldorf Astoria. Goldman Sachs is being the most flexible here. So we got Goldman Sachs has been reduced to 4,300. And I give them the Nimble Award. I would say FundStrat and Oppenheimer are just not nimble. They're saying the market's going down and now it's super, super, super cheap. And Morgan Stanley's saying it's gone down because we told you so. We've been telling you so for the last 5 years, and we're finally right. And he's a perfect contrarian indicator. They reduced their targets on average by 4%. Earnings estimates are down 1%, but your bottom-up analyst estimates are up 1%. So you're getting a divergence when your strategists are saying earnings are down, but your bottom-up are saying earnings are up. And they're up on oil. Bulls are stubborn. Goldman Sachs is agile. And the polarized bear is Morgan Stanley. And let me see, Stolfutz is saying buy. I mean, a lot of this stuff I've weaved through my discussion, but tech will rally. Petrol prices are diverting spending, moderating demand, destroying jobs. So that'll bring inflation back down. Don't worry about it. Walmart and Target were short-term issues. And he's saying, oh, here's the company, Digital Turbine. So last quarter, he said buy Digital Turbine at 48. It's down to 27. And I like it. It's a good company. But it's getting washed out with all those super high growth companies. I didn't say buy it, but now I might say buy it. It looks like it's a good company. So Thomas Lee, he's your FANG guy, right? And he's saying, oh, they're cheaper than companies with no growth, like a food stock or a Procter & Gamble. A lot of things can go right. Labor markets could ease. Retailers could sell off their excess inventory. The CPI could come back down. Supply chains could come back online. The war could end. So there's a lot of stuff that could go really well. And I think he's right. I mean, we could easily be towards the bottom of this correction. And getting back into some of these high growth stocks might be good timing. I think Google at 15 times earnings is a steal. It's had tremendous growth since we've owned it over the last 5 or 6 years. Really, really good growth in earnings estimates and profits and in sales and everything. And 15 times earnings, I mean,
Where's the greenback going?
okay, that's Steve, Chris, you want to comment on the dollar versus the Aussie or versus the euro or versus weight trade weighted?
Well,
That's true. I wouldn't start with trade.
in the long run, the biggest determinant in exchange rates against the Aussie dollar is the interest rate ratio. So the U.S. interest rate is on target to be significantly higher this time next year. It seems the RBA is a bit more dovish in their approach, so that rate differential will widen, which would long run suggests that the USD should stay in that 65 cents is basically, on a purchasing power parity basis is about right. So it could fall. So the Aussie dollar could fall 10%.
Chris, you want to add to that?
Yeah, I think it's, yes, especially the, maybe elaborate a little. Yeah, it's the policy divergence, which will prompt a change. So, but broadly speaking, RBA, if they're sort of in moving in pretty much the same direction, or the expectation is, particularly after the GDP figures were slightly higher than expected today for Australia. So yeah, we're always looking for divergence in monetary policy.
So the US has come out of the COVID pandemic faster and harder than anybody else. So they're raising interest rates faster and harder than anybody else. So the US dollar should lead ahead of anyone else. Okay, so the US dollar should be strong compared to anyone else, especially with Europe with its problems. So comparing it to Europe is tough. Comparing it to Australia, I don't really have a view on that one. We got a new leadership here, which is, yet to see what's happening there. Fangs, buy Fangs, buy Fangs. 4 of them outperformed. Amen. Why have I got that? Should be Amazon. AMZN. That's a typo. And NVIDIA. So the outperformers, Facebook's actually going. I think Facebook's a disaster. I wouldn't go anywhere near Facebook. But Microsoft and Alphabet look really good. NVIDIA's looking pretty good too. So of those Fangs, I wouldn't buy Facebook. I think they're done. Done. I think they're horrible.
Free cash flow and,
But okay, so let's have the debate, Steve. I think that people are shifting to other things like Snap and Instagram and other social media
They own
areas. And I think that this shift into the metaverse is a great big diversion from their declining core business. Why do you think they're?
I totally agree with that.
Oh, okay.
The meta investment is probably going to go down. That's about like the Libra currency.
Okay, does anyone ever remember me saying Carpe Diem?
Yes.
You remember Carpe Diem? Okay, so that Facebook came out with this currency called Libra. Okay, and I said this is dead on arrival, and then they changed its name to Diem, and then I said, oh, now they got crap Diem, crap of the day, right? So I just think that is an indicator of a failure within an organization that is looking to this new metaverse, which is scary. I was reading about people who buy real estate on the metaverse and then get hacked and lose. They bought $80,000 worth of real estate on the metaverse, and then they get phished by someone who sends them an email saying, oh, let me have your password, and they get social phish. And do you want to explain what social phishing is?
I'm familiar with phishing.
Okay, so
but I'm not
phishing
sure
is
about
where
social.
you go to an employee of a bank and you say, hey, employee, we gotta get you to let me in. So that's when you're phishing and you're getting an individual employee to, so it's social
Sharing their
phishing.
credentials, basically.
Yeah, what?
Sharing their credentials.
Yeah, and so that's how you hack, is through social phishing. Right? Anyway, so maybe I have the wrong word there. Let me move on. Bears. Okay, Goldman Sachs. I do really have the most respect for Goldman Sachs and David Kostin. He reduced his target from 47 to a range. He's following Amari down. He is the most nimble. And I do think that Goldman Sachs is the best risk managers on Wall Street. They have been since I got into this business in 1985. And I do respect what they're saying. Financially, environment has changed a lot. So you have higher interest rates. You have yields, real yields were negative and now they're positive. You got widening credit spreads and the US dollar is up, making imports cheaper and foreign earnings worth less. So you do have some fundamental changes in what's going on with the changes in financial conditions. He's not forecasting a recession, but a lot of his clients are. They're looking at very wide standard deviation or wide range in expectations. We're going to have stagflation. We're not. And there are a lot of people who are concerned about a recession. So that's causing some sell there. Excuse me. 11 million jobs available, 6 million workers available. So you got a gap of 5 million, and he says the Fed has to tighten to destroy jobs. We got to destroy 5 million jobs. And then it's demand destruction, job destruction is the name of the game, which is unusual, was something I've never heard before. So we got to destroy the economy. We got to destroy jobs. We got to destroy demand. So he says buy companies with good solid dividends that are growing their dividends. Amgen, Pepsi, and United Parcel Service are his key picks. Mike Wilson, well, he says sell, but when does he not say sell? So let me let the guys talk about some stocks now that we're recommending, because we've got just about enough 15 minutes for you guys to talk about stocks now.
Okay, so just some brief updates on the 10 stocks comprising the relative value portfolio. We're outside of the earnings season, but a couple of companies did report. Goldman Sachs is have the leading trading and M&A franchises, and M&A activity remains very robust. It's actually running at about 8% year to date, below the level of activity last year. But Goldman Sachs has expanded on their market share. 27% of the deals they've advised on this year, and typically in the last 2 years they've commanded a share of around 20-21%. So that's pleasing, but also they're diversifying their revenue base, which is helping to smooth their overall financial results, given the inherent volatility in their leading divisions. So the Marcus, digital consumer banking, and the very capital light asset management businesses, they're making some good headway there. So I think there'll be a better comparable to JP Morgan going forward, and should attract a JP Morgan type of valuation, as distinct from a more Wall Street oriented bank as they have been in the past, like who's close comparable with I think Morgan Stanley. 8 times earnings, and after the 60% increase in the dividend last year, nice yield of 2.5%.
Can I ask a question?
Yes.
The risk profile of somebody like Goldman Sachs being in equity versus a bank being in debt is a fundamentally different thing. However, Goldman Sachs, I mean, we've seen investment banks fail. Bear Lehman, Shearson, Merrill Lynch. So somehow through the global financial crisis, we have now Goldman and Morgan Stanley. But why aren't they out there taking all the risks, and why do they trade at discounts to the money center banks? Because their risk profile, their risk managers, and they're on the equity side, on the debt side. Why are they not considered more stable?
Perhaps they are. I mean, fundamentally they are. Most of the post-GFC regulation has centered on leverage and prop trading, taking those risks.
So you think the government regulations made them safer?
Yeah.
Ronald Reagan say? I'm from the government. I'm here to help. Right? I think that's right, though, Chris. I think that's a good point to make. So I'm with you on that. I think that regulation and stress testing and prop trading and all that stuff has made them much lower risk.
Yeah.
So
I'll just briefly touch on Activision Blizzard, which we have added to the relative value portfolio this month. It is a merger arbitrage investment. And the details are that Microsoft will be paying all cash, $95 per share to shareholders by June 30th, 2023. We think that this deal has a high probability of completing, because the regulatory hurdles that they have to overcome really aren't significant. This is a vertical acquisition for Microsoft. There's a lot of competition in the video game sector, and so we don't see a major regulatory problem. In the event that it doesn't complete, Microsoft will pay Activision $2 billion cash in a breakup fee, which is one of the largest that I have ever seen. That accounts for about 4% of Activision's total market capitalization, and that gives us some mitigation of the But Microsoft could close this deal tomorrow if they want to. They've got more than enough cash on hand. And incidentally, the day we made this investment decision, Berkshire Hathaway announced an 11% stake in the company with the same thesis. This is really a workout over 12 months, and our expected return from the current price is about 22%. Paramount, we've had steady growth at Paramount, which was formerly known as Viacom. They changed their name in the last 2 quarters. They had 20% growth across all of their streaming platforms, but the Paramount Plus paying platform now has 40 million subscribers, and their Pluto TV platform, which is an ad-based subscription service, has 68 million. So, pretty robust growth across their streaming platforms, trading at a fairly reasonable 14 times earnings, which is a discount to the market.
They don't have Johnny Depp or Amber Heard, do they?
No, but they do have Tom Cruise
Yeah.
and Top Gun. Had the biggest global box office receipts this past weekend in history with 200.
Is it bigger than Court TV and the Johnny Depp Amber Heard stuff?
Well, it is bigger. It did surpass Pirates of the Caribbean in 2007, which had the previous record. So Johnny Depp is now
People say it's good, it's bad.
it's meant to be good. Yeah, it's had good reviews. They finished this movie a couple years ago and made a strategic decision not to release it until after COVID. And they also made the decision to release it in theaters first, not on the streaming platform, which apparently Tom Cruise really pushed for. It's theaters. So a very good result. Paramount is the executive producer, so they will be benefiting from that. I'll hand it to Chris to discuss financials.
Thanks, Steve. So a couple of our healthcare industry companies reported earnings out of cycle. Viatris was the first and outperformed this month after a solid first quarter result. Free cash flow and EBITDA were the main beats exceeding estimates, and they also said that Russia and Ukraine issues are really just immaterial. And importantly, maintain their fiscal year guidance on revenue, EBITDA, and free cash flow. So very good, clean result and a catalyst for some improvement in a stock that's been a laggard and remains at an extremely discounted valuation. Trades at very low multiples of free cash flow and pays a very attractive dividend. Moderna also outperformed this month, following solid results. Per share earnings and sales, which comprise almost 100% of which comprise the COVID vaccination, albeit, and
That's a good beat.
very big bet. Yeah, but I think, given the significance of the beat in the first quarter and the maintenance of the full year guidance on sales, that was disappointing in the sense that perhaps some of those sales were realized in the first quarter are a bring forward from later in the year, but they've raised their guidance twice this year, calendar year so far, in January and February, and they've said that they could raise it again if the US government commits to buying variant-specific shots in anticipation of fall. Yes, so it's, most of the discourse remains around the COVID vaccines, but the rationale for our investment is the mRNA platform that they've developed over a little over a decade. The COVID vaccination has been a proof of that technology, and there's about 25 other medicines and vaccines in development, and those, as they advance towards commercialization, that will be a catalyst for the stock.
Alphabet. Well, as Joe said, it's just a great deal. Trading at 14 times earnings if you carve out their cash. They are growing revenue at 20% annually. They are expected to have $100 billion in profit next year. They just announced a $7 billion buyback, and this is a theme we're seeing across a lot of these big cash flow generative companies in technology in particular, are massive buybacks, which is how and these tech firms are returning capital back to shareholders. Currently, Apple has a $175 billion buyback program in place. So just huge amounts of cash flow.
And that's not gonna stop. Goldman Sachs is talking about buying stocks with defensible dividends and growing dividends. And, you know, they said, be careful because buybacks will be the first to go.
Yeah.
But a buyback for Alphabet's not gonna go. They got so much cash, their buyback is not at risk.
Yeah, they bought back 70 billion last year and they've approved another 7 billion. And so they've been pretty consistent with growing the buybacks each year and completing them.
It's only about a little over a year of free cash flow. So it's accumulating as fast as.
They're spending what they're bringing in. Yeah, they're spending.
Not quite, actually. We've got 135 billion in cash, 15 billion net cash. So
And you don't hear much about the moonshots anymore. I mean, they really hauled in that sort of stuff, right?
yeah, yeah, they have curtailed a lot of these expenses that were going nowhere. Although there's potential for
Waymo.
for their driverless vehicle division to profit sometime in the future. I mean, there's a lot of opportunity there in those other bets, but they're focused on controlling costs and expenses and growing the YouTube and ad platforms.
It seems to me that, one of the most important things they need to do is image management, because they don't want to become politicized and be a target from Democrats, Republicans.
Yeah.
So just maintaining a neutral image.
And I think that's why a lot of these tech companies are discounted, is because of the concern around potential.
Well, Twitter's minority woke. The vocal minority woke in employees have really screwed Twitter and really screwed Disney
and Netflix, although they've
and Netflix too.
Netflix has changed their.
It's significant if just written a letter to all staff. If you don't like our programs, go somewhere else.
That's it.
Oh, we encourage you to go somewhere else.
Which was great. So Netflix is maybe the first major company that's pushing back against the very vocal but small woke minority, which is crazy.
If you don't like my investments, we share. We share. We debate. We have fun.
But we're not.
We come to no. Well, no.
I'll just.
I am kind of like sympathetic to them. Yeah, but let's.
Okay.
That's a surprise.
Qualcomm, they are benefiting from the rollout of the 5G technology globally. They are essentially the only provider to the Western world. That's why Huawei has been shut out of the market. They are focused on growth areas of the business beyond just their chip division. They're looking at acquiring, taking an investment in ARM Holdings, which is going to IPO from SoftBank in the next 12 months, I believe. Qualcomm is interested in a controlling position in that, trading at 10.9 times earnings, very good value with a reasonable dividend yield. I'll hand it to Chris.
We have 3 minutes, I think. Chris.
Yeah, I realize we're
Oh, no,
probably
we're right on
on or
time,
maybe
so let's-
slightly
yeah.
over. So, Boeing. Oh, there we go. So they suffered from company-specific issues, the MAX, and then COVID, and that this trend is now reversing. And there's a lot of leading indicators which support an earnings recovery, but it hasn't been without turbulence. Joe, I know you love a pun. But yes, the leading indicators we're looking at are things like the vaccine penetration and the recovery in commercial travel, the order backlog, the liquidity position of the business, and our assessment of normalized earnings is around $15, and that would reflect about a 9 times multiple. So
We got in too early, but it is going to double when it doubles. When it goes, it's going to go.
it's going to take off.
When it takes off, it's going to soar.
And Western Digital was also an outperformer this month after interest from an active investor. Elliott Management built a 6% stake, about $1 billion, with a commitment to spend another $1 billion as part of their plan to split the two businesses. And this is despite some success that the current CEOs had over the last 2 years, expanding their margins. This discount of the stock relative to peers has really just persisted. And so in addition to the operational improvements, we now have another potential catalyst if Elliot's plan is adopted and successful.
Fair. Great results this last quarter. It's all about their crop science division, which is about 50% of sales. That is the former Monsanto. And this is a very relevant thematic with the supply issues for wheat and other agricultural products because of this war in Ukraine, Putin's war.
Fertilizer prices went up 80%.
Yeah. So we're
So
seeing
that means people are going to buy these crops.
yeah, the need for more efficient, productive, arable land is very relevant. And so demand for their crop science glyphosate product is, well, sales are up 22% a quarter. And 2 quarters. Earnings per share grew by 36%. So, I mean, it's paying a 3% dividend and it's only 8.6 times earnings. This looks like a great buy for us.
There's still some risk about settling. There was some stuff about California having some lawsuits, cancer settled in California versus other places. So there's still some residual class action lawsuits from the Monsanto cancer issues that Bayer took on. They went down a lot because of that, but we think that's, there was a little bit of volatility on that this month, but we think that's
For the most part,
it's, we think that's well understood what the risks are there, but we did see a little volatility.
And that is why it's so cheap. It's been discounted because of all of the Monsanto litigation that's gone on in the last 4 years.
Yeah.
And it's presented an opportunity. So here's our 10 stock relative value portfolio with 2 supplementals. We're very proud of our long-term track record.
So that's it. We'll thank you very much, and we're happy to stick around and answer questions. And